In this video, we are talking all about how to mitigate the high interest rates of the day, so stay tuned. What's up everybody, it's Cassandra Lopez with the Living in Bremerton channel. If you're new to the channel, go ahead and subscribe, tap that little bell so you're notified every time I drop a new video. Whether you're moving here for the first time or you've been a local for a while, go ahead and hit subscribe, tap that little bell, and you can reach out to me directly if you need any support in your relocation. This is my phone number and my email. Feel free to call, text, or email if there's anything I can do to support you. So rising interest rates, the hot button item of the day, and believe me, I have heard every reason why to not buy a house right now from here to doomsday, all in regards to the high interest rates. Let me just give you a little perspective. There's two things that you're paying for when you buy a house. You're paying for the house, so that's the cost of the house, that's the purchase price that you and the seller agree upon. You're also paying for the money that you're borrowing. So the interest rate is essentially what you're getting charged to borrow the money. It's the cost of money. So you're paying for those two things, right? One of them's fixed, which is the price of the house. The other one's variable, which is the interest rate. So right now, interest rates are high, which means home prices are coming down a little bit, right? So it makes sense to buy a house when you can get the house portion for less, because that's the part you're committed to for the rest of your life, or at least for the rest of the time you own your home. Right now, interest rates are high, so people are backing out of the market because they don't want to pay that much to borrow the money. But if you look at it from this perspective, you have really limited competition. Sellers are willing to compensate in regards to price and or concessions. We'll talk about that here in a minute. And you can refinance when rates come back down, at which point your home likely will have appreciated. So now you have like all this amazing built-in equity. So let's talk about the first way we can mitigate those high interest rates to get your payment down to an affordable place. And that is to take advantage of seller concessions, great buy downs, that sort of thing. So a lot of lenders right now are doing what's called a 2-1 buy down. And this is where they take a concession from the seller. So the seller's gonna pay some money at closing towards your rate buy down. They take that money, okay? So for the first year after closing, the first 12 months, your rate is a full 2 points less expensive than whatever your quoted rate was. So say you were quoted 7%, you're at 5% for that first 12 months. For that second 12 months, so now this is the one part of the 2-1 buy down, the second 12 months, your rate is 1 point less expensive than what you were quoted. So if you were quoted 7%, now your rate is gonna be 6% for that second year. So first year it's 2 points down, which is 5%. Second year is 1 point down. Now at the end of that 24 months, it's gonna go back up to your quoted rate, whatever that was. In this example, it was 7%. So you have 24 months to refinance your property, or it's gonna go up to that 7%. So it's almost like an adjustable rate, but it's not, because at that 24 months, it's like fixed at that 7 forever until you refi. But the idea is that you can really, really mitigate that high interest rate and have a really affordable payment for the first couple of years, at which point interest rates are projected to go way back down. You can refinance and you can put yourself in an awesome position. Now, it should be stated that a seller contributing a point towards the buy down does not directly equal a point reduction. When we talk about points in the real estate industry, it is a 1 percentage point of the purchase price. So say the purchase price is $500,000, 1 point would be $5,000. So that means that if seller contributes $5,000, a point towards your rate buy down, your lender will take that $5,000 and they will buy down that rate as much as they can. So it may look like you're quoted 7%, seller contributes 1 point, $5,000, and maybe it goes down to 6.5. So it's not a straight across a point for a point. It's whatever the interest rate of the day terms are. And that's a great question for your loan officer, your lending professional, because that kind of gets into the weeds of all of that stuff. And really, there's no one rate that applies to everybody. There's no way that a lender could say, oh, I'm going to quote you 5% when everyone else is getting quoted 7%. That just doesn't exist. And if he's telling you that, something's up. But also, it really depends on your specific scenario. So like what your credit score looks like, what your debt to income ratio looks like, what your reserves look like, what loan product you're using, that makes a difference, what county you're in. There are so many factors that there's no way a lender can just pinpoint a loan for you until they receive your application and actually look at your financial picture of what's going on there. Another way to mitigate these high interest rates is by using what's called a fixed ARM. So ARM is an acronym. It stands for adjustable rate mortgage. So it kind of sounds like a fixed ARM would be kind of an oxymoron, a contradiction in terms. Like how the heck is an ARM fixed if it's by definition adjustable? So right now there are lending partners that I work with who have a short-term fixed ARM. So maybe a 5-year or a 7-year fixed term. Okay, so what this means is that you get locked in at a more favorable rate than a fixed 30-year mortgage rate. And you're locked into that ARM rate for 5 years or 7 years or whatever terms they have. And by the end of that 5 or 7 year term, the idea is that interest rates will have gone back down. You can refinance your rate into like a fixed 30 or 15-year rate, something that's more favorable, but also fixed now for the life of the loan. It will no longer adjust because refinancing essentially pays off that first mortgage. So these fixed ARMs, they're not for everybody. They have a slightly higher criteria that you need like a high credit score, you need, more money in reserves, you need, a couple of other overlays because it is kind of a larger risk for the bank to take, but it's worth the conversation. So talk to your loan professional, talk to your lender, see if that might be a good option for you, because if you can get into a fixed ARM, say at a 5-year term, that's like at 4.5% or 5%, well, shoot, that's like a no-brainer, right? And then you refi later when rates come back down and everybody lives happily ever after. A third way to mitigate these high interest rates is by having a large down payment. And I know this isn't accessible to everybody, but if it is to you, do your best to put as much down as you can. The idea being, the less money a lender or a bank is lending you, the less risk they're going to be taking on your behalf. And so they're willing to offer you a more favorable interest rate most of the time to compensate for that lower loan amount. So if you have a family member who's willing to gift you funds, if you just won the lottery and maybe you pay off a bunch of other stuff and you have enough left down for a house, whatever your case may be, sometimes if you have like a retirement account, like a 401k or something, they will allow you to draw against that without any taxes if it's specifically for a home purchase. You're definitely going to want to talk to your financial planner and or CPA about that, because that is outside the scope of what I do. But I know it can be done, and so that's why we're talking about it, just to give you an idea of a way that you could make that work. So if a large down payment, 20% or more, is accessible to you, then absolutely go for it. You're going to avoid mortgage insurance then as well too. So, but if you don't have a down payment and that's just not accessible, then let's try to take advantage of some of these other ways we can mitigate these high interest rates. If you're buying a house right now, I applaud you. First of all, congratulations. That's amazing. I'm glad that you are taking the steps to become a homeowner for the first or second or third or fifth time. But it really needs to be stressed that obviously we don't want to be paying these high interest rates forever. The idea is to buy now while home prices are affordable, while you have minimal competition, while sellers are willing to concede in price and or offer money for closing costs or a rate buy down. That's a great position for a buyer to be in, so you definitely want to take advantage of that. But we don't want to be paying these high rates forever. So the idea is that we're going to refinance maybe in 12 or 24 months or whenever rates come back down lower than what you're paying now. And you can refinance your house as many times as you want. So say in another 2 years, rates drop even further, refi again. But you can only do that if you keep your financial house in order. and that is make sure that you're on top of your credit all the time, you're on top of your spending, you're on top of your debt to income ratio. So if you buy a house and you close, don't go out and buy like 4 new cars, don't max out your credit cards, don't put all of your appliances on your Home Depot credit card. You want to make sure that you keep your debt low still, because when you go to refi, they look at that stuff all over again. It's not like once you're in a house, it's like one and done. Every time you apply for a new mortgage, which is what you're doing when you're refinancing your home, they're going to take a look at what your financial picture looks like right now, today. So make sure that you really maintain that, because if you do, you'll totally set yourself up for success in the future when it comes to refinancing and getting into a more favorable rate. Also, the more favorable your credit score and debt to income ratio, the lower your rate is going to be in general. And so that's another reason why it's really important to keep all that. If you're not buying a house right now and you're waiting, like I hear from 80% of the buyers who, well, I guess they're not buyers because they're waiting, right? 80% of the potential home buyers that are out there who are waiting for interest rates to come back down. So the reason I hear from them is that it's too expensive to borrow the money. They're gonna wait for rates to come back down and rates are better, and then they're gonna get back into the market. So the thing with that is that that's what everybody's doing. So if everybody is out of the market right now waiting for interest rates to come back down, what do you think is gonna happen when rates do go down? Everybody's gonna get back in the market and flood the market. What does that do? Increases demand. Inventory is going to start ticking down like it did over the last 2 years. Prices are going to skyrocket like they did over the last 2 years. And now, remember at the beginning of the video, we talked about the 2 things you're paying for, the house and the money to buy the house. Those are the 2 things you're paying for. Now the house price is going to go skyrocket, even though the cost to borrow the money is lower, but now you're locked into that home price forever. So I don't know, to me that doesn't sound like a win. It sounds like you just paid more for a house than you needed to, because you could have bought one right now and you're paying 10 or 15 or 20% less for a house than you would have a year ago, even though the interest rate's a little bit higher. So what? Refinance later. So those are the cons of waiting. The pros of waiting, well, you know, you'll have a lower interest rate later, but you'll still have to compete for the house, probably pay more for it than you would in today's market. And we're gonna see that whole stress cycle all over again that we lived through the last 2 years. So anyway, I digress. Call me if you want any actual factual details on that. I can refer you to a lender who can have a very candid, confidential conversation with you to see what a home purchase might look like for you. And like, there's no charge, there's no obligation, it's just conversation, you know. But like I said, they really won't know exactly how to advise you until you make application and they can see exactly what is going on with your financial picture. And again, even if you do make application, there's still no cost or obligation. It's just a more scientific, more specific way of looking at your financial picture and what it would look like to buy a home for you. So if you like that video, give me a thumbs up, tap that little bell so you're notified every time I drop a new video. Please share this one with a friend if you think they might benefit. Be sure to text, call, or email if there's anything I can do to support your relocation to Bremerton, Washington. Bye for now.